Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome to a special edition of Blue Chip Now. We have an afternoon episode where we thought it might be nice to address some common client questions. So I'm going to let Matt kick this off, but before I do, I'll explain the rules. We gathered 12 common client questions. We're going to have 2 minutes to answer each one. And we're going to start right now.
Awesome. So specifically, the timer will start after we read each question. So number one question. Not the number one question. We're just starting with this question. I should differentiate. What is the difference between an RIA, a registered investment advisory firm like Blue Chip Partners, and a big brokerage firm, for example, like a Merrill Lynch?
So I'll start. I think when I think about RIAs, registered investment advisory firms, I think of independence. When I think of big brokerage firms, I think of companies that are possibly owned by publicly traded companies where earnings are very, very important at the end of the day. And so there's kind of a different approach to business, one that's more driven on profits versus when I think of the independent RIA space, I think of a more customized, objective approach to serving clients. RIAs also operate as fiduciaries. So we have to, by mandate, act in our clients' best interests, where I think a lot of the other types of firm structures out there that are regulated by something called FINRA have to operate under what's called a suitability standard. So the standard is just different. It doesn't mean that their advisors aren't out there giving good advice or that they're trying to take advantage of their clients. But I think they're held to or RIAs, I should say, are held to a different standard where every piece of advice that they give have to be defended if the SEC were to come in and audit the practice. Anything else come to mind?
No, I mean, it sounds like there might be a size difference here too. So, when we think of RIAs, does that necessarily mean smaller, larger?
Not necessarily. I mean, I would say that the established big brokerage firms like a Merrill Lynch or Morgan Stanley are, by and large, bigger because they have most likely been around for a longer time. And keep in mind, there are a very large number of RIAs that have come from previous wirehouse or big brokerage firm teams, right?
Yeah, I don't know the numbers here, but the amount of assets that the wirehouses or the big brokerage firms oversee is massive. It's a huge number. But here we are.
So
Dan,
2 minutes. So Dan, maybe it's a segue. Can smaller RIAs compete as the industry consolidates?
Yeah. Well, work me through. What do you mean when you say the industry consolidates? What do you mean by that?
Well, I think we see fewer and fewer options, for clients, and particularly in the RIA space, the registered investment advisory space, we see a lot of firms buying up these independent RIA practices and kind of lumping them all together.
So the small advisor who's independent is getting purchased or gobbled up by a larger conglomerate that still could be independent. And the question is, can the independent, call it one man, one woman, or small,
or firm like Blue Chip?
Yeah,
we're not private equity backed, not rolled into some larger organization.
So we only have 2 minutes. I mean, I think of scale can help larger firms. So in the world of cybersecurity, larger firms are going to have better technology to protect clients from things like cybersecurity. I think of technology like trading resources and the ability to offer clients online portals. All of that might be more sophisticated on a larger RIA platform. Where the smaller independent RIA or one-man, two-man shop or a smaller firm might not have the resources to cover that type of technology cost. But from a client experience perspective, I think the independent organizations, the smaller organizations, can customize the client experience. And so, it's this tale of two different, it's kind of a tug of war. The larger firms are going to try to systematize their delivery of what clients are receiving. And a lot of times I think that can mean less customization to the client.
And I think ultimately, right, it's gonna the client's experience can be defined by the talent at the organization, so credentialed individuals perhaps, and technology. I think of Blue Chip, having Tamarack, using that as our CRM trading software. Massive firms use that software. We use that software. So
2 minutes is up.
Yeah. So shifting gears here, Daniel, maybe I'll throw this one to you or direct this one towards you. So kind of the generic question: what happens when X party wins the election?
Generically, some passionate individuals will be happy and some passionate individuals will be sad. But if we're talking about markets, I think this is almost an impossible question to answer. I don't think there's a right answer to this question. The reason I say that is because if you look back through history, going all the way back to the 1920s, there really isn't a great deal of rhyme or reason when you look at market returns relative to who was in the Oval Office.
So it matters more for the direction of the country, maybe less so for the direction of stocks.
Yeah, and don't get me wrong. I mean, there have been certain terms where we've seen certain policies that have made their way through that do have influence on financial markets. But I don't think that explicitly, if it's a red or a blue candidate in the Oval Office, that explicitly impacts your returns in financial markets.
And one thing I find fascinating, and I think as market discussion dominates the news cycle, we have TV channels dedicated to market discussion all day, every day. I do think that generally speaking, the layman or most people view the stock market as the barometer for the economy. Mm-hmm. And I do think that either party getting elected is generally speaking going to want the stock market to go up. They want that on their report card after 4 years. So whether you're blue or red, I do believe that at the end of the day, they want a successful stock market and business environment on their report card during their term in office.
Yeah. And I've talked a lot about just a gridlock in Congress. So the Oval Office seems to dominate the headlines, but at the end of the day, there's still a race in Senate and the House. And so when there is some type of gridlock in Congress, that forces the parties to reach across the aisle. The system is designed for compromise, and a lot of times that's what we get. So we might not. Historically, I think the data suggests. On to the next question. We'll talk about the historical data in one of our future podcasts.
Yeah, so we can table that for another discussion. And Dan, if you want to finish up your sentence, I think that's fair. But so this is a more specific question. This is one that's pretty interesting. I'm curious what your guys' answers are and how to answer it. But we've heard some discussion about unrealized gains being taxed. What do you guys think? What happens if unrealized gains get taxed? Is this feasible as a policy?
I'll start. It's not feasible. I don't know how you could possibly find the resources to value small businesses or to, go out there and understand what the actual unrealized gain is in something that isn't mark to market on a regular basis. And so I think from a sheer resource perspective, it would be extraordinarily difficult. I can't even wrap my arms around how you would do that.
Well, I don't even think you need to go that far to try to understand how crazy this would really be, because I think essentially this would be just a very backwards policy to implement. Because if you say we're going to start taxing all unrealized gains, let's just say it is on just publicly traded securities, what does that do? That basically disincentivizes you from investing in public markets. Yeah. What happens if you're all disincentivized from investing in public markets? What happens to the economy? What happens to businesses that support the economy? Yeah. You guys can do the math.
Well, or do we create an environment where stocks delist, they go private, right, and then the end investors having to purchase some type of private equity or some type of fund with outrageous fees at that point. So,
to me, it seems like one of those policies that's a negotiating tool at the table. I just don't see how it could be possible, but could be used as leverage in a negotiation.
And where you could get, in theory, like I said, not that I'm a proponent of this, but I've heard people say that the correct way to implement something like this would be the people who are the mega wealthy, who just get security-based lines of credit on their stock portfolio, borrow against it, never actually sell anything, pass away and get a step up and avoid tax more or less their whole entire lives. There could theoretically be something you could do with that type of scenario.
Take away step up in basis or something along those lines, or They're also talking about lowering after the sunset in 2025, the estate tax exemption amounts.
Yep.
There's other ways to address the issue of revenue.
Yep. So next question, what's Blue Chip's investment strategy?
I'll kick it off, and I'm going to try to keep this very straightforward and simple. And it might not be an answer that you guys are expecting with this specific question, but our investment strategy is time in the market, right? And when I say that, it's not completely disregarding security selection or asset allocation, but it's time in the market. So our investment strategy is to put forth a portfolio that can incentivize staying in the market or encourage staying in the market, because time in the market is going to beat timing the market 10 times out of 10. So the more you can incentivize or encourage clients to stay invested, the better the investment strategy should be.
Yeah, so it's the investor experience.
Right.
The investor experience. And we do that. Maybe give us some insight into how we do that.
Yeah. So of course, I mean, I think, again, the biggest mistake people can make is pulling their money out of the market at the wrong time. The more you have a volatile investment experience, if your investment portfolio is chopping around significantly, both to the upside and downside on a month-to-month, week-to-week basis, certainly that can be acceptable for the certain type of person with a long time horizon and a significant degree of investable assets. But for the average person, that's scary, right?
And we as financial advisors do behavioral coaching to make sure that we can partner with our clients and help them emotionally through difficult times. But really, at the end of the day, what's your investment strategy? We're investing in individual stocks, and we're investing in a bond portfolio that's made up of low-cost ETFs and mutual funds. Do you want to touch on that, Matt?
No, actually, I want to touch on just giving a different answer like Daniel did, because Dan, this is something you say. Our investment strategy is one that backs into a financial plan.
Yeah, that's another great answer.
So ultimately, the investment strategy, we talk about dividends, we talk about individual stocks, but it's one that we can use, and we can use the income generated by the portfolio to back into somebody's in financial plan.
Yeah.
At the end of the day, as an income replacement. So as we shift gears, though, this will probably segue into the follow-up question that you had. What's the difference between a stock, mutual fund, and ETF or exchange-traded fund?
Daniel, maybe stock?
Sure.
Talk to us about what's a stock. And we have under 2 minutes. This is a lot.
Okay. Let's keep it high level.
Yeah.
A stock is, think of it as just owning a piece of a business, right? Back in the day, you would literally have a piece of paper, right? Like, here's my receipt. I own a piece of
Coca-Cola.
XYZ company, right? So a stock is a share in a business. You participate in the profits, you participate in any challenges, et cetera, et cetera. Mutual funds and ETFs are both collections of securities. So let's just use a stock as an example. A mutual fund or an ETF is a collection of stocks. If you're building a stock mutual fund or ETF, there are significant differences between mutual funds and ETFs, even though they sound very similar. Mutual funds are traded only once per day at the end of the day. They have a net asset value, and the price you pay for a share of this mutual fund, which is essentially buying into the shares of many different stocks, trades at the end of the day. An exchange traded fund or ETF is, just as the name would imply, traded on an exchange. You can track it intraday like a stock.
So if I put in a sell order to sell my mutual fund, it won't sell until 4 p.m.
Correct.
If I put in a sell order to sell an ETF, it'll sell instantly throughout the course of the day.
Correct.
Got it.
Yeah.
Anything to add there?
I would say, mutual funds and ETFs, generally speaking, can be managed. So you can pay a manager to purchase various stocks or bonds, trade them in and out of the account. They can track indexes. So you could buy a mutual fund or ETF that just tracks an index, like the S&P 500. Okay. Interestingly enough, mutual funds can be a little tax inefficient. If that manager's done a lot of buying and selling over the year, they're going to pass along potentially a capital gains tax to the holder of the mutual fund, unbeknownst to them.
Great.
So that's interesting. One thing that we talk about a lot, and just I think we should break down for people, what's a dividend?
Well, this is a good kind of segue from what's a stock. So you've still got that receipt, right, for that share of XYZ company. At the end of a year, for example, XYZ company has a decision to make because they've just made millions of dollars in profit. What do they do with that money? They can go buy another business. They can pay off some of their debt. They can reinvest in the business, maybe upgrade the machinery that helped them produce that profit. or they could reward some of the people that have financed them along the way and believed in them. And so to do that, they distribute some capital to their shareholders. That's called a dividend. A dividend is received by an investor, and dividends are generally paid quarterly. They could be paid annually. There could be special dividends. But really, it's a distribution from a company to shareholders.
So let me tie together. So Matt, you said that our investment strategy is one that backs into a financial plan. We talked about what's a stock, what's a mutual fund, ETF, what's a dividend. Dividends are paid per share, not per share price. So if you have 100 shares of a stock and it pays a $1 per share dividend, that's $100 in income that you're going to receive from that dividend. Whether the stock price goes up or the stock price goes down, you're going to get consistent cash flow. So the one thing I love about dividends is there's consistency. There's often consistency, not always, but there's often consistency to what they offer in terms of cash flow.
Yeah, I agree. And generally, a dividend is going to be something that's going to be issued by a more mature business with more stable revenue, more predictable cash flow. Because the last thing the board of directors wants to do is raise a dividend and then cut the dividend and then raise the dividend. Dividends, like to Dan's point, are generally speaking can be very stable. They can increase over time, and at the end of the day, that's kind of the attributes that we like when we're looking at stocks. So. Next question, logically, I
Last
guess.
thing I would say, at the buzzer, what is a dividend? A dividend can potentially be a very, very meaningful portion of total return.
Yep.
That's a good topic for another episode.
Yeah, that'd be great, yeah. So, this is a pretty general question, but I think a great question. How much should I have in stocks?
Yeah, this is another one where there's no right answer. This is a very personalized question. The common notion that you should have 100 minus your age % allocated to the stock market. Is that right? Is that the
No, I've heard the rule of thumb.
Right.
I would say it's not right.
But that's what people say, right? Yeah. Either way, my point in saying it is, I think there's no one size fits all approach. What your allocation to a riskier asset class like the equity market should be is directly dependent on your ability to tolerate risk. So that is influenced by your time horizon, how much you have in investable assets, your general risk appetite, et cetera, et cetera.
And when I think of that question, stocks is really broad. Like what type of stocks are we talking about? Are we talking about Verizon? Are we talking about a small cap pharmaceutical company that may or may not hit this blockbuster drug?
Right. Not all stocks are created equal.
Not all stocks are created equal. Not all businesses are created equal.
And here's a different approach to it. And this is in no way, shape, or form a recommendation to anyone. But oftentimes, the best outcome over time would be 100% stock portfolio or allocation. So allocated 100% to stocks over time will get you the best outcome. Why don't people allocate 100% to stocks? Why do they have portfolios that consist of 80% stocks, 20% bonds, 70, 30? It's because they can't handle the volatility. And so when you take risk, you get reward, and the price you pay is volatility. And so a lot of times people can't handle that volatility. And so for that, we add bonds.
Yeah. So, you don't want to speed 100 on the freeway. It might get you somewhere the quickest, but you could get pulled over.
Am I going to get an award for dad of the century because I drove 140 miles an hour to get my kids to Disney and I got them there on time, safe?
Depends who's asking.
Yeah.
So another great question. Should I buy when the market is high? And maybe I'll start here. And the answer is absolutely, right? Because generally speaking, markets that are high keep going higher. Obviously, everybody would love to be able to buy low. Put all of your money in low when the markets are at a bottom and then ride the wave all the way to the top and sell right at the peak before it goes down. But generally speaking, that's proven to be a nearly impossible strategy for anybody to replicate consistently over time. But we do believe in trends, market momentum, and as a market and a stock that's going up continually is likely to continually keep going up. It's because it's generally a great business, right? We don't find a lot of bad businesses going up.
But what drives price? Earnings.
Right.
And so we are in a corporate environment where corporations are savvier now than ever before. They have really strong management teams and they're able to produce greater and greater earnings. Higher earnings are often paired with higher stock prices. And so, should I buy when the stock market's high? Well, I don't know. Think back to 2013 when the stock market broke out of the downturn that occurred after the global financial crisis. You could have said at the end of 2013, whoa, stocks are high. This is the highest stocks have ever been. Well, if you weren't an investor in stocks from the end of 2013 to today, what's your opportunity cost, right? So should I buy when markets are high? It's all relative. I mean, 5 years from now, you're going to look back at today's pricing. You could look back at today's pricing and say, wow, I really missed out.
And I think it's more, you should be comfortable buying stocks at high. You should be comfortable buying when stocks are low. In 2010, 2011, there weren't a lot of investors that were super excited to get back in the market. But the key is consistency and sticking with the long-term plan, I think. And that's what you have to have because, we won't pick the highs. We won't pick the lows every single time. So, Daniel, I have a bit of a curveball. This one could be a fun one. We've all experienced this, and people are often scratching their head, but why does a stock go down after they beat their earnings?
Yeah.
Or why can that happen?
There's a number of ways you can explain this. Honestly, there's a limitless number of ways, but I'll just give you a few examples. Let's just say a company just beat on earnings, but it was all sourced from some abnormal profit, like a one-off occurrence, right? I don't think that if one specific oddball occurrence supporting a healthy earnings beat, I don't think that's going to be looked favorably upon by investors, right? Mm-hmm. If that's masking some lack of profitability underneath the surface, a stock might sell off. So you have to go underneath the hood. Another reason you might see a stock sell off after beating on headline earnings would be because the path forward isn't as rosy. So companies will issue something called guidance, which is basically just their estimate of what a future level of profitability or revenue or some other metric looks like. If the previous year of earnings were strong or attractive, but the following year is not supposed to be attractive as per management commentary, given the market is forward looking, it wouldn't be surprising to see a stock sell off. So these are just a couple of examples, but realistically, I would say just keep in mind the market is a forward looking entity. So trailing earnings are not always the most important item to consider in terms of stock price movement.
So I'm, I think more in terms of the technicals, right? The supply and the demand of what drives price. So buying and selling. In a very simple sense, stocks go down when there's more sellers than buyers. Mm-hmm. And at the end of the day, that is what it is. So regardless of what the earnings are for the company, when more sellers flood the market than buyers, the stock price will go down. It can happen for those reasons. Sometimes it can just be momentum. It can be an algorithm at a big, hedge fund or institutional pool of money that sends it lower because they triggered a sell.
Right.
So, how do we know when to sell stock?
I don't know. If you find out, let me know.
Right.
No, but in all seriousness, I think the best way for me to answer this is just by taking an approach centered in risk management. We all know that there is no crystal ball, right? If you know exactly when to sell, if the market is high, then, I would love to hear about it. But the fact of the matter is we just don't have that luxury. So to me, the right time to sell is going to differ person to person. But one commonality should be when a position of any kind gets to be so large that it is encompassing the vast majority of your risk allocation or risk exposure. That's concerning because we've all been taught or we've all heard about the benefits of diversification.
Too many eggs in one basket.
If you have a position that becomes 10, 15, 20% of your overall allocation, I don't really care what your time horizon or risk tolerance is. That to me is just not a prudent investment decision. So you have to make a change.
Well, and I would also add, one thing people don't often think, we talk about in the investment committee a lot is competition for capital, right? We only have so many slots, if you will, for stocks in the portfolio. What we're not trying to do is have 150 stocks in a client's portfolio. We're trying to limit the number somewhere between 30, 40, give or take at any time. So a lot of times we sell a stock when we think there's a better opportunity in a different business that we really want to add to the portfolio.
Right. Yeah. And Matt, you touched on earlier, you said stocks that make or markets that make 52-week highs or all-time highs tend to continue to do that. There's a theory called momentum. Stocks that are trending higher, continuing that trend. Stocks that are trending lower, continuing that trend. When should I sell a stock? Well, I don't know. Have a game plan laid out before you buy the stock so that there's a trigger. And maybe that trigger could be relative underperformance to something like a broader S&P 500. If I breach a certain relative performance, I sell the stock. So there can be triggers as well.
Yep. No, that's great. So final question, a little bit different topic or topic type. At what age should I share my financial situation with my kids?
That's a tough one. But I think the general answer is as soon as you're comfortable, and the sooner the better, because I think inevitably your kids are going to find out what your financial situation is when you eventually die and pass money on to them. So it's good to have a plan. Does that mean that you tell your 8-year-old what the balance sheet looks like? No, I don't think so. But when your kids are maybe mature enough in high school or college to understand that this is sensitive information, they're not out there running around telling their friends on the playground, to start bringing them into what you have. I think that's a healthy thing for most families, but not all kids can handle that, and not all parents are comfortable sharing that information. So again, you have to customize this. But I think because of the inevitable nature of us getting older, dying, passing down wealth to our kids, when you can bring them into the mix and have adult, mature, or serious conversations, I think it's better to have those conversations sooner than not at all.
Yeah, and I think the conversation to have soon is, teaching kids the responsibility with money, how to save, how to budget, all those types of things are really important and can lead to the maturity down the road to eventually be able to share your financial situation with them as well.
Yeah, and what better way to lead by example? So if you're trying to encourage kids to save, you could say, hey, I've saved, and here's what happened to my money as the snowball started to roll down the hill and compounding occurred. So the lessons, lessons that you can pass on from showing your kids what you've done can help them understand and see in the real world how it can happen.
Yeah. I mean, I was just talking to my 2-month-old about the power of compounded interest last night, and I'm excited to see him start putting that into action.
Outstanding.
Yeah, if he starts now.
That's right.
It's a pretty good time horizon. So that's going to be a wrap on our first Common Client Question podcast.
Yeah, we're going to keep doing this. I want to say on most
send in
likely,
questions. I would encourage clients to send in questions. The more we can get from you, the more we can source on our sheet, and the more future questions and the more podcasts we'll have.
Yeah, we're going to try to do this on at least a quarterly basis. So like Matt said, fire in questions. And until then, we'll speak to you next time.